Greetings, Dr. Rivas. So the company we decided to do our analysis on is Macy's Inc. And I thought it would be a good idea to start with the mission statement. So you can see it there on the screen, a pretty wordy mission statement. The first sentence really points to Macy's vision, or what Macy's ultimately wants to accomplish. Their goal is to be a retailer with the ability to see opportunity on the horizon and have a clear path for capitalizing on it. I don't know, it seems pretty vague to me, but the second sentence really points to how Macy plans on achieving that vision. From the second sentence, we can see that to achieve their goal, they're going to try to use more technology and put more resources towards what the customer wants. Next slide. Just a brief introduction of Macy's Inc. So first, what do they sell? Macy's sells a lot. They offer a wide variety of products, including apparel, home furnishings, cosmetics, and other consumers' goods. And also, they sell their merchandise through one of their many store locations and also through their website. Where do they operate? Macy's operates mainly in the United States. As of January 20th, 2021, Macy's operated 727 store locations in 43 states, the District of Columbia, Puerto Rico, and Guam. And then lastly, Macy's recently released a new strategy on February 4th, 2020 called the Polaris Strategy. And it has 6 main components. The first component, win with fashion and style, relates to Macy's delivering fashion and style that the customers want. They plan on doing this by transforming their assortment architecture, fashion curation, inventory productivity, and supplier rate relationships. The second component, delivering clear value, relates to Macy's building trust and relationships with customers through simple pricing and promotions and a personalized loyalty program. And then the third component, excel in digital shopping, just refers to Macy's enhancing their online shopping experience. The fourth component, enhance the store experience, refers to Macy's investing in making the store shopping experience more convenient and engaging for their customers. The fifth component, modernize supply chain. That relates to Macy's creating a faster and more efficient customer fulfillment infrastructure to support continued growth. And then lastly, the sixth component, enabled transformation, relates to Macy's modernizing technology and embedding advanced analytics into every aspect of the company's business to create a performance-driven operation model that executes the rest of the Polaris strategy.
So go over the industry overview for Macy's. Macy's was started in 1858, and since then it's really developed itself as one of the top retail department stores in the United States. They've done this through high-end customer service, really good products, and a lot of advertisement. For example, every year you see the Macy's Thanksgiving Day Parade. However, overall, the department store industry has kind of been struggling. As you can see, in 2011, there were 8,600 locations of department stores nationwide. Now, in 2020, there's only 6,000, so it's been steadily declining. With COVID-19, the economy has been weakened, or people trapped inside, they've turned to online shopping. This obviously doesn't help the physical locations that department stores have, and has gone to more and more people shopping online. So go over Porter's 5 forces. We'll start with threat of new entrants and barriers to entry. Getting into the department store industry is not easy. It requires a significant amount of capital. This is to buy physical locations for your customers to shop at, get inventory, and find qualified employees. It's also important to consider the benefits that an established company has compared to a new entrant. For example, an established company has economies of scale because of the quantity and just the amount of product they're producing. It allows them to minimize their costs and gives them an advantage. There's also supply chain. A new entrant has to focus on establishing a supply chain, whereas an established company already has thousands of suppliers that they have good relationships with and have been able to trust in the past. When a new entrant comes into the industry, it's also feasible to consider that they might face retaliation from some of the other established companies. This could result in the more established companies dropping their prices to price out the new entrant. In order to kind of break through this, a new entrant has to differentiate themselves. There's several ways to do this. It can be having discount prices, having an assortment of products. They can focus on having really good advertising, quality, service, having specific locations that they have their stores in. It's a number of ways to do it, but it helps give them kind of their own little spot in the market. Also, with the online retail building up, it's important to realize that having online stores helps minimize the brick and mortar physical overhead costs that other companies have to deal with. A good example of this is Amazon. While they have a couple of stores, they don't really have to worry about those costs because they don't have physical stores as much. It's also been an increase in the amount of websites and the investments that have gone into online retail websites. As far as threat of substitutes, the retail department industry is highly competitive. There are several substitutes that consumers can look at. This can vary depending on the quality, if they want to get discount or high-end brand name products. As I said above, it's important to differentiate yourself to kind of stand out. For Macy's, it seems like they kind of focus on establishing brand name products. It's one of their ways to kind of differentiate the products. They've created private label brands, and that's been effective at minimizing the risk of substitutes. In the retail industry, the suppliers have a significant amount of power. This is especially true if the firms don't diversify their supply chain. Knowing this, a lot of firms have focused on a lot of different suppliers. For example, with Macy's, they have the Supplier Diversity Program. This program focuses on working with small businesses and minorities to help bring in high-end products. And it's a win-win for both sides. One, they get a number of suppliers that they can trust on with good quality products at low prices, and for the vendors, it allows them to get a major department store to be one of their customers. If there's a ton of competition, this affects the prices, and it ends up shrinking the overall profit margins for the other companies. In regards to the power of buyers, Macy's faces intense competition from its competitors, and this is all due to them vying over a lot of the customers. To avoid this risk, they can grow the customer base. The more customers they have, the less impact a smaller group will have on the overall business. And Macy's has realized this, and to overcome it, they focused on really improving their customers' experience. And this has involved investments with their customer service team and investments on their physical store to create an overall better experience. In regards to rivalry and industry structure, the department store industry is highly competitive, as I've said, and when there's increased competition, profit margins are shrunk. With the increase in online shopping, this has only been boosted, and it's added more pressure to more brick and mortar stores like Macy's. It's important to maintain customer loyalty. It's crucial to be able to have your customer base and maintain your relevance to them. Some of the key competitors for Macy's include Amazon, Burlington, Dillard's, Kohl's, Nordstrom, Sears, Target, and Wayfair. When you look at Macy's opportunities, one of the big opportunities is improving their customers' experience in physical stores. While a lot of companies are going to online retail, Macy's is locked into 15-year obligations with some of their physical stores and realize that they are very dependent on the success of their physical locations. Realizing this, they've invested a significant amount of cash into everything from faucets to the rest of the store and the lighting to make the customer have a really good experience. It's also important for them to develop and grow their private label brands. This is a way for them to stand out among their competitors and help avoid substitute products coming into and interfering with the business. They've already established some private labels, and this is run through their MMG subsidiary. They're also focused on expanding their omnichannel capabilities, which helps create a really good customer experience, whether they're shopping online, in the store, and make a smooth transition between all interfaces with the company. By creating a really good online presence, then they can even go and expand into international markets. Threats for Macy's really focus on the downturn in the market due to COVID-19. Overall, the economy is struggling right now, and that affects the amount of consumers and what they're willing to spend. This has also affected the shift to online sales instead of brick and mortar stores. Macy's is going to have to focus on overcoming this shift and working on really enticing customers to come into their physical stores while having a good option for them online that creates a good experience.
To begin the internal analysis of Macy's Inc., we first looked at Porter's value chain to perform a value chain analysis. Overall, Macy's Inc. creates value by purchasing high-quality goods from vendors across the world and creating their own high-quality goods through their private labels to sell at their department store locations or on their website. Some highlights from their support activities include that they have been focusing on data analytic technology to support their key business processes, such as providing their management with immediate access to performance, talent, and compensation information for their teams to ensure the best decisions are made. Some highlights from their primary activities are that they own subsidiaries to enhance their efficiency in the inbound logistics, operations, and marketing, sales, and activities. Through these subsidiaries, they are keeping their primary activities mainly in-house, which allows them to have total control and quality assurance in the work being performed. The distinctive competencies of Macy's Inc. include having strong name recognition, a wide variety of women's product offerings, and prime store locations. Name recognition is a competency for Macy's since they have a strong history in American retail through their flagship store in New York City, once being the largest department store in the world. Also, that they are involved with a major U.S. holiday, which is Thanksgiving. Due to their annual Thanksgiving Day parade, they are considered a household name and remain relevant every year. Women's product offerings is a distinctive competency for Macy's because they own the largest amount of market share for women's products across their competitors. To compare a few, Macy's women's product offerings make up 58% of their sales, when Burlington, Kohl's, and Dillard's are all in the 20 to 40% range. Store locations is also a distinctive competency due to the fact that they prioritize locating them in densely populated areas. These activities previously mentioned are all interrelated because they are all aligned with their firm strategy to remain relevant in the retail market despite the decline of department stores. In February 2020, Macy's announced the Polaris strategy, which is a multi-year plan designed to stabilize profitability and position the company for sustainable, profitable growth. This demonstrates their commitment to staying relevant, which is demonstrated in their distinctive competencies. The activities are also interrelated because of their strong roots in the history of the retail industry in America. Since Macy's first opened in 1858, they have remained a recognizable household brand name and show recurring relevance every year due to their Thanksgiving Day parade. Overall, we found that the strengths of Macy's Inc. include their strong name recognition, their commitment to omnichannel abilities, their dedication to retaining employees through the use of data analytics, and the wide variety of product offerings, as well as their success in the women's product offerings. Their weaknesses include their vulnerability to vendor price fluctuation, strong competition from other department stores, and their declining department store market. Suggestions that we have that could be made in some of the areas of the Porter value chain to improve organizational performance include using data analytics in the marketing business function, This would help to see what areas of marketing are responsive to increases in sales and which are not, so that Macy's can best allocate the use of their vendor allowances. Another suggestion is to negotiate long-term fixed price contracts with vendors to protect against undesirable economic fluctuations. Right now, Macy's is extremely volatile to shifts in prices from vendors, and it could be detrimental to their business.
Hello, my name is Ben Abraham. I will be covering portfolio analysis for Macy's. In this section, I'm analyzing the sales from different business segments between Macy's and 3 different rivals. The information is from sales in 2015 and 2020, calculating the growth in each segment and the relative market share for each company. The rivals I selected to compare to Macy's are Kohl's, Burlington, and Dillard's. I chose these companies for many reasons. In order to be able to be compared, the companies had to report information on similar business segments to Macy's. This eliminated large, relevant competitors like Amazon and Walmart, because while they provide services that directly compete with Macy's, they do not report similar segments to Macy's because their business is too diversified when it comes to the segments they offer. Another limiting factor was the rival had to be publicly traded, so their information was publicly available. This eliminated private department stores that would have reported similar business segments, like JCPenney. Finally, I took the largest 3 rivals located in the US that were able to be compared to Macy's, and that left me with Kohl's, Burlington, and Dillard's. The first graphs I am showing are Burlington and Dillard's. They have relatively smaller market share than Macy's and Kohl's, and are definitely in a lower tier than their other 2 competitors. As you can see, they each have 3 dogs and 1 question mark, leaving them in a precarious spot, like most department stores have been in 2020. As you can see for the BCG analysis charts here, a much more relevant competitor to Macy's is Kohl's. Macy's has 3 cows and 1 star, while Kohl's has 2 cows, 1 dog, and 1 star. I think there are a couple things to take away from this analysis, that being the decline of the traditional clothing sales in brick-and-mortar stores, along with the potential of the home and appliance industry for department stores. The in-store apparel industry has taken a sharp decline. Unfortunately for department stores that are heavily leveraged in apparel like Macy's, the COVID pandemic only sped up this decline. Millennials are a growing customer base, and what they want from their shopping experience is very different from any previous generation. The goal of a department store is to have lots of options and for customers to take their time and peruse around. However, millennials tend to not want to waste their time browsing all day and prefer quick, instant gratification so they can move on to their next task. This is why online shopping has appealed to them greatly, especially during the pandemic when it was not feasible to go out to retail apparel stores. For Macy's, they need to use their well-known name brand and build upon their online shopping experience so they can capture the millennial market along with the older generations that still want to shop in in-person stores. The main point to make here is lots of companies are trying to go online with their store, but many are failing. You need to make sure that you have a refined experience that sets you apart from other companies, or your investment into online shopping will be a failure. A different route Macy's could go, which is supported by the BCG charts, is to expand upon their home and appliance industry. A main reason why this industry has fared better than the apparel industry is that people tend to like to do their shopping for big purchases like appliances in person. Macy's has been able to hold their ground on the in-person home and appliance industry due to this fact. But I think that even online shopping could greatly impact this industry as well in the near future. If Macy's was able to get out in front of this, they could be in a phenomenal position in the home and appliance sector when compared to their competitors. If this was a route they wanted to go, I recommend they acquire AppliancesConnection.com, a leading provider in online appliances that has only been accumulating awards and glowing reviews for their services. If Macy's could provide more capital and their well-known name, I believe this is a marriage that could be very beneficial to Macy's based off the information I've gathered from the BCG analysis.
We have also performed a financial ratio analysis of Macy's and Macy's competitors to analyze how Macy's stacks up against its main competitors. The ratios used for this presentation provide insight into the following companies' profitability, growth, solvency, and liquidity. First, we will look at profitability ratios. So as you can see from this graph, Macy's is underperforming compared to its competitors in terms of profitability. In every ratio used, Macy's is in the bottom 3. And in terms of net income margin percentage, Macy's ratio is the lowest. Another important thing to note from this graph is that all the traditional retailers, aka Kohl's, Burlington, Dillard's, and Macy's, they all have a negative net income margin percentage. Amazon and Wayfair are the only 2 competitors listed here that actually make a profit from its business model. This supports our previous analysis regarding Macy's weaknesses because this proves that Macy's is in a declining market due to the rise of e-commerce companies such as Amazon and Wayfair. But next we'll look at growth ratios. So yeah, as you can see from this graph, Macy's again is underperforming compared to its competitors. The only data that was provided for Macy's was total revenue growth and gross profit growth. And in both of these ratios, Macy's is in the bottom 2. Specifically, second to last in terms of total revenue growth and dead last in terms of gross profit growth. Again, similar to the profitability graph, all of the traditional retailers show negative growth ratios. Amazon and Wayfair are the only companies listed here that have grown in terms of revenue over the past year. And this just proves our earlier claim that the department store industry is declining and the e-commerce companies are growing. But next we'll look at solvency ratios. So when looking at this graph, we can tell that Macy's again is underperforming compared to its competitors in terms of solvency. For the 4 ratios used in this graph, Macy's is in the bottom 3 of every ratio. But unlike the other 2 graphs, there's not a big difference between the traditional retailers and the e-commerce companies. In this graph, we can see that Amazon and Dillard's is outperforming the competition, and Burlington, Wayfair, and Macy's are significantly underperforming. But lastly, we'll look at liquidity ratios. So from this graph, we can see that once again, Macy's is underperforming in terms of liquidity regarding the current ratio, which measures a company's ability to pay off its current liabilities with its total current assets. Macy's is second to last. Regarding the quick ratio, which measures a company's ability to meet its short-term obligations with its most liquid assets, Macy's is in dead last. So the key takeaways from this ratio analysis just relates to the fact that Macy's is in a declining department store industry. Traditional retailers are reporting negative net income and shrinking in terms of revenue, while e-commerce companies are growing and very profitable. The main challenge that Macy's faces relates to these e-commerce companies. In the past, Macy's was successful because of their great customer service, their brand name, and their variety of products. But now customers prefer to shop online, not the old brick and mortar. If Amazon offers more products at a lower price and better customer service, how does Macy's survive? That's the question they got to answer. And they have to find a way to compete with these e-commerce companies by growing their online presence and expanding their omni-channel capabilities.
To begin this section, I first want to give a little background on the reasoning behind my overall conclusion. First, Macy's has an overall objective to operate as dynamic national brands while focusing on the customer offering in each store location. As far as segmentation of Macy's is concerned, the company operates in one reporting segment. However, they provide sales records for a number of different areas, which I'll dive into a little more on the next slide. Next, Macy's targets mainly middle-class women between the ages of 16 and 34. This is the most popular demographic to go to and spend money at malls, so it makes a lot of sense that Macy's would try to cater to the needs of this large potential customer base. Also fitting in with the typical middle-class theme, Macy's has a position of offering quality products at reasonable prices. Some competitors of Macy's have taken positions either offering premium products at high price points, such as Nordstrom, while others offer more discount-type products at cheaper price points, like Walmart. The main sources of revenue for Macy's include in-person sales, online sales, and real estate. Being that the company has invested tons of money throughout the years building and developing real estate for its store locations, there is a large potential to increase revenues by selling the real estate the company does have. This could become a major source of revenue if the company decides to shift online and close many of its brick-and-mortar store locations in the future. I wanted to take a minute to talk about competition within the industry. While competition was previously mentioned to be high in the industry, there are many driving elements for the competition in multiple ways Macy's can maintain itself as a leader in the industry. Some of these driving elements of competition include price, availability, the development of the online platform, and advertising. All of these factors lead us to our overall recommendation for Macy's, which includes building up and maintaining the online presence of the company, integrating existing stores' customers into the online platform, and making use of the company's strong and efficient omni-channel capabilities. On this slide, I just wanted to give a little more in-depth look at how the company earns its revenues. While the company only reports its sales in one operating segment, they provide sales breakdowns by the areas shown on the charts on the slide. The first area for Macy's is women's accessories, intimate apparel, shoes, cosmetics, and fragrances. This area is the largest by far for Macy's in terms of revenues, making up over 40% of total revenues in the 2020 fiscal year. In addition to earning a higher portion of revenue than any other area, it's the only area that has grown as a portion of sales each of the past 2 years, improving from 37.87% of revenues in 2018 to 41.54% of revenues in 2020. It makes sense that this area would be comprising a large portion of Macy's overall sales, as it fits perfectly within their target customer of middle-class women between the ages of 16 and 34. The second area of revenue breakdown for Macy's is women's apparel. This area makes up only about 17% of total revenues for the company currently, decreasing each year since 2018 in terms of both total revenue and as a percentage of total revenue. CEO Jeff Gennette stated that he believes that apparel is going to continue to shrink as a percentage of their overall business over time, which fits exactly into what's been happening lately. The third area is men's and kids. This area has remained fairly consistent in terms of percent of total revenue, decreasing slightly in 2020 to roughly 20%. And finally, the fourth area of Macy's breakdown revenues is the home and other. This includes appliances, other home products. This is the only area of the company that has not seen any tangible revenue declines from 2015 to 2020, as shown previously in the BCG matrix. Looking at the chart on the top right of the screen, we can see that every area of Macy's has decreased revenues overall each of the past 2 years, which is obviously concerning. On this slide, I'm going to go over a few strengths of Macy's and see how they could be turned into opportunities overall. First, Macy's has a wide array of products. The wide variety could help Macy's grow its presence in international markets long term. The second strength of Macy's is their strong CRM system. The company can use this system to help customers become more immersed in the growing online platform. The online platform, as I will discuss in later slides, is a key area for the company to maintain profitability long term. Finally, Macy's does have a large and strong e-commerce platform. Macy's was ranked number 14 in the 2020 Digital Commerce 360 Top 1,000 Online Sellers. If Macy's can improve this e-commerce platform even further, it will help the company long term, as brick and mortar stores are losing favor to online platforms, especially in terms of profitability. While Macy's does not have a breakdown of its net income in terms of brick and mortar versus online, Finance Chief Adrian Mitchell stated that Macy's e-commerce business is now more profitable than its stores business. This means that Macy's can improve its sales even further online. They can improve profitability into the future. Looking at the weaknesses of Macy's can help us realize where potential threats could come into play. First, Macy's has a low presence in many countries. This opens up the possibility of local favorites being targeted more heavily in these areas, which could effectively corner out Macy's out of these markets altogether. Second, Macy's has an over-dependence on the United States market. This could provide a major threat in the future if a harsh decline in sales due to a recession in the United States occurred. And finally, Macy's has a high amount of fixed costs tied into their large amount of stores. This could limit profitability long-term if the company is unable to make changes to shift to receiving more business from the e-commerce platform. Overall, the strategic recommendation we have for Macy's is to continue to grow the online presence of the company to maximize the efficiency of the omni-channel capabilities. Macy's needs to utilize the increase in customers they've seen during the pandemic to drive future sales online. In the fourth quarter of 2020, Macy's acquired 7 million new customers, leading to a 21% year-over-year sales growth. In addition, as I mentioned previously, e-commerce is the most profitable channel for Macy's, which lead me to the belief that shifting to primarily online sales with the aid of stores can allow Macy's to succeed moving forward. However, this does not mean Macy's should close its brick and mortar stores completely. Adrian Mitchell stated that Macy's online sales per capita were around twice or 3 times higher in markets where it has in-person stores. These stores act similarly to billboards, as customers are constantly reminded that Macy's is still around when they drive past the actual store locations. Online sales see an adverse effect when stores are closed, which is seen very prominently in areas where Macy's has effectively left completely. After considering the strategic recommendation that we believe would be best for Macy's long-term, we've created an implementation plan to determine whether Macy's could feasibly carry out the plan by looking at net present value and expected internal rate of return. After looking at the factors of the company and management's views on shifting more towards e-commerce, we determined that a likely sales growth online is 9% annually. This is derived from management believing they could reach $10 billion in online sales in 2023 compared to $7.71 billion in 2020. We determined a pessimistic growth rate of 5% long-term, which would be a situation where online presence virtually does not improve as anticipated. However, we have set an optimistic revenue growth for online channel of 13%, where obviously this would be better than expected. The system gets rolled out faster than expected and more successful. After determining an initial cost of $30 billion to completely get the omni-channel presence up to speed and ability to grow these potential figures long-term, we've determined that this project would be worth it to move forward with for Macy's. The project has a value of $15.3 billion long-term. In addition, using the likelihoods of each scenario occurring that we have projected, we have an expected internal rate of return of 32%, which is higher than the projected cost of capital. As a result, we've determined that this project would be worth it for Macy's to carry out.